You know what drives financial experts absolutely crazy? Watching people treat the stock market like a slot machine while completely ignoring the credit card debt that's charging them 22% interest. It is like trying to fill a bucket that has massive holes in the bottom. You pour money in, hoping for growth, and wonder why you're never making any actual progress. Most people do this backward. They buy crypto or hot stocks before they have a safety net. It is like buying a Ferrari when you can't afford to fix your current car's transmission. There is a mathematically optimal order to invest your money, and getting this sequence right can save you tens of thousands of dollars over your lifetime. Here is the exact step-by-step sequence for building wealth efficiently. Step 1. The psychological safety net. Before you invest a single dollar in the market, you need an emergency fund. The data is alarming. The median American has only saved $500 for emergencies. That is less than a monthly car payment. You need to start by saving your first $1,000 immediately. Then, build that up to 3 months of living expenses. This isn't just about having cash, it's about psychology. Recent research from Vanguard found that people with just $2,000 in emergency savings had financial well-being scores 21% higher than those without. This fund creates a buffer that stops you from selling your investments at a loss or racking up high-interest debt when life inevitably throws you a curveball. Step 2. The 100% return. Normally, paying off debt comes next. However, there is one major exception. If your employer offers a matching contribution to your 401k, you must contribute enough to get that match immediately. Think about the math. If you have credit card debt, that is a negative 22% return on your money. But an employer match is a guaranteed 100% return instantly. It's literally free money. Take the match, then stop. Do not contribute a penny more until you handle the next step. Step 3. Kill the financial cancer. Step 3 is eliminating high-interest debt. This refers to anything charging over 8% interest, which usually means credit cards. With average rates over 22%, this debt is financial cancer. It grows faster than almost any reasonable investment return you could expect from the stock market. Carrying this debt while investing is like trying to run a marathon with a backpack full of rocks. To solve this, use the avalanche method. List all your debts, pay the minimums on everything to avoid penalties, and then throw every spare dollar at the specific debt with the highest interest rate. Every dollar of principal you pay off here provides a guaranteed 22% return on your money. You won't find a risk-free return like that anywhere on Wall Street. Step 4. The tax optimization zone. Once the high-interest debt is dead, do not go back to your 401k just yet. Open an individual retirement account, or IRA. This step comes before maximizing the 401k because corporate plans often have limited investment menus and high management fees that eat into your returns. An IRA gives you total control and lower costs. For 2025, you can contribute up to $7,000. You have 2 choices here, traditional or Roth. The rule of thumb is simple. If you are currently in a high tax bracket, choose traditional to get the tax break today. If you are young or in a lower bracket, choose Roth. With a Roth, you pay taxes now, but all that growth and every withdrawal in retirement is completely tax-free.
Step 5. The secret weapon. If you have a high-deductible health plan, Step 5 is the Health Savings Account, or HSA. This might be the most powerful investment vehicle in America. It is the Swiss Army knife of investing because it offers a triple tax benefit: tax-deductible contributions, tax-free growth, and tax-free withdrawals for qualified medical expenses. Here is the pro strategy. Pay for your current medical bills out of pocket if you can afford to. Let the money in your HSA stay invested in the market. Keep your receipts digitally. There is no time limit on reimbursement, meaning you can pay yourself back from the HSA 20 years from now, tax-free, after the money has compounded significantly. Since the average couple spends over $300,000 on healthcare in retirement, this account is essential.
Step 6. Max out the 401k. Now that you've maxed out the IRA and HSA, go back to your 401k and fill the bucket. The 2025 contribution limit is $23,500. Between your IRA, HSA, and 401k, you could potentially shelter over $35,000 a year from taxes. That's a massive amount of wealth, compounding without the IRS taking a cut every year. Step 7. The Wild West. Only after maximizing every tax-advantaged account do we look at taxable brokerage accounts. This is where most people start, and it's a mistake. Taxable accounts offer flexibility. You can pull the money out whenever you want for a house or early retirement, but they suffer from tax drag. You get taxed on dividends and capital gains every step of the way. Over a 30-year period, tax drag can cost you nearly $250,000 compared to a tax-advantaged account with the same returns. Use this bucket for flexibility, but only after the other buckets are full. This is the blueprint: emergency fund, employer match, high-interest debt, IRA, HSA, max 401k, taxable accounts. This sequence builds a financial fortress. Most people never get past step 3 because they have a low savings rate. But if you follow this order, you aren't just saving, you are optimizing every single dollar for maximum efficiency, minimum tax liability, and minimum risk. Do the boring work first, and the wealth will follow.